Hey, what's happening, guys? Dan Darrow here with another Options and Play video update. So today I'm going to talk about a credit strategy. Okay, most of what I do, nearly all of what I do, and all on what most of the options and play is, revolves around debit strategies. So debit strategies meaning long premium, right? Credit strategies means short premium, selling premium, collecting premium. Okay, so one debit strategy, defined risk, right? If you pay $2 for an option, then the max you can lose is $2. Credit strategy is different. Credit strategy is you're shorting that contract, you're selling that contract up front to open the trade, you collect the premium of $2, but then your risk is much different. So your risk could be theoretically unlimited if you sold a call, if the stock keeps running and running and running, or your risk if you sold a put would be the stock collapses to zero and you lose the difference between the put strike and zero, right? Now, I don't normally do credit strategies, but something we spoke about at our option session this past Monday was an idea of using credit strategies into like the teeth of this drop, right? So implied volatility, I've spoken about it a lot the last 2-3 weeks. Sometimes implied volatility, it can work in your favor. Other times it can work against you. And where I have been saying that a lot of contracts are very expensive, keeping me away, right? Because I'm saying the implied volatility is too high, like the pricing is too high. Now that can work in your favor if you're selling, right? So if you're saying like the options pricing is so high that I don't want to get involved, well then you can look at that maybe from the opposite spectrum and saying that the prices are so high, maybe it's worth getting involved, right? So, kind of what I'm going to focus on this week in some of these videos is kind of how to take advantage or potentially position uh, after like this major move lower, right? Like if you want to put on either some longer term strategies or look at some like longer term positions, like what or how you can go about it. All right. So a credit strategy, right? Now, this to me revolves around the ability to actually own the stock, right? Like I would only say that you would want to do this if you were comfortable owning the shares, right? So some people want to sell premium just as like a day trade, 2 day trade, right? They say like I don't think the stock's going to go above that. I want to sell calls or I want to sell puts. That's not what this is. This strategy revolves around. This strategy revolves around you looking at a stock saying like I want to potentially own it at such and such level and I'm going to design an option trade to potentially take advantage of it before it gets to that level. Okay. Now Apple. I know most people have an opinion on Apple. Some people maybe they say it's come down enough. Some people might say like it's not gone down as far as it should, right? Or there could be more room lower, right? So for argument's sake, let's say that you have been watching Apple and you're really interested in buying right around like the June low from last year, right? Like say like around like 170 to 175, right? Right now Apple's trading at, you can see here, it's trading at like 219 to 220, right? Now, there's a chance if the market bounces pretty aggressively from here that Apple might never get down to 175, right? So you say like I want to be long 100 shares of Apple if it gets to 175, but right now the stock is 40 points away from that, 45 points away, and there's a chance that it might never see those prices, right? I mean, maybe for whatever reason it just doesn't get down there. Now, what I am saying is like if you were already comfortable owning Apple at 175, like, and that's where you wanted to buy 100 shares, then what you could look at is selling a put. Okay, now again, like the implied volatility is very high, and when I go out to these prices, you'll see. So the 175 strike puts on Apple that go through May expiration, right? So this is only about 2 months. This will go through earnings though. So the 175 strike puts that go through May are trading for about 750, say 750 or so. Okay, so what you could do is you could say like, okay, I want to own it at 175. I'm comfortable owning it at 175, right? But you acknowledge that the stock is 45 points away from that, and it might not see 175 by the middle of May. So what you could do is to potentially capitalize on like the stock being where it is, right? And option pricing being high. Is what you could do is you could sell the 175 strike put. You collect 7.5 points, right? If the stock drops down to 175, then you're going to have to commit to owning the shares of 175. But realistically, your cost basis is actually 7.5 points lower, right? Because you sold the put for $7.50. So your cost basis isn't actually 175. So if Apple were to close at like 174.99 to like the penny on May 15th expiration, then your cost basis isn't 175. Your cost basis is 7.5 points lower because that's the amount of money you collected for selling that put, right? So your cost basis is 167.50. So if Apple closed on May 15th at 174.99, you're still actually technically $7.49 in the money, right? So again, like this is like something that revolves around you being comfortable and or willing to own the stock at a certain price, right? But also kind of acknowledging that like maybe your prices are awfully aggressive, and there's a chance that Apple may never get down to that 175 to get to the level that you're comfortable owning it at, right? So that really high implied volatility, right? What I had been saying over the last 2 weeks is that it's kind of prohibitively high for opening debit positions. Well, if you look at it from the opposite spectrum, right, then maybe that's worth taking a look at for credit strategies, particularly on names maybe you want to own at lower prices or at certain specific prices, right? So this is like an idea. I probably wouldn't go out much more than like 1 to 2 months. Um, just because once you go out a little bit further, yeah, I mean, you're going to be able to collect more premium, right? Because there's going to be more time value. But right now, the implied volatility is so high in shorter term options that you could see like a greater rate of decay on those like shorter term options. And then, if Apple by May 15th is still trading at 220, well, then you can look possibly at selling like to July and kind of repeat the process all over again versus like selling in September, then you got to sit for like 4 or 5 months for the option to expire. Okay. So, like I said, I'll do a couple videos this week, kind of like talking about how to potentially take advantage of this drop, whether it's credit strategies or maybe like getting like a playlist together or like a list together of names you might want to play into this bounce or what you want to maybe look at for like a uh, longer term trade potential. All right. So if you like these videos and you're looking for more information on options trading or more information on options education, please follow up with the link in the description of the video for more information on options at play. Um, just really important, just stay safe, stay healthy. We're going to all get through this together, all right? Have a great night, and I will talk to you all tomorrow.